Welcome back for another episode of Strive for 25. Joel Farrell here, and looking forward to sharing with you our guest today.
Another episode of the Strive for 25 podcast, and I have an amazing guest on today, Chris Odegard. And I'm really looking forward to this topic because he's an alternative investment type of guy. He's a blogger, educator, speaker, author of the book Get Off Your Ass and Manage Your Money, and a lot more to it, websites and blogs. But Chris, thank you so much for taking time out. And if you would just kind of give us a little bit of a brief background on what all that you're into.
Sure. Thanks, Joel. Well, I was, like a lot of Americans, I was a conventional investor at one time, stocks, bonds, mutual funds, and the 401k highway to mediocrity. And I had an illiquidity event in my mid 40s where I lost 55% of my assets. And I stumbled across a book that your listeners are probably familiar with called Rich Dad, Poor Dad. And, I switched to alternatives, and that's everything that's outside of the stock market. And in 9 short years, I made up that 55%, multiplied it many times over, quit my corporate job, and now I do what I want, when I want, and I live off my investments. And that never would have been possible had I stayed on that 401k highway to mediocrity. So today I'm an alternative investor, primarily real estate, multifamily syndications, but I've dabbled in all kinds of things, and and I've kind of narrowed my focus, and and that's kind of what I do today.
So for the listeners out there, we've got a range of types of people that are listening to the show. So we've got people that are in the very beginning of their stages that maybe don't have much investments at all. We have people that are in the middle of their journey, and people maybe in the later stages of their journey and looking to be able to kind of take some next steps to be able to get ahead. And one of the things that I'm a big believer on, regardless of where you are in your journey, we always say this: when your why is strong enough, the how figures itself out. So if you don't know where you're trying to go, how are you going to get there?
Right.
And, when you talk about the different types of investment vehicles, having an idea of what these things can do for you can help you kind of pinpoint your vision and pinpoint, where you want to be able to take your life and your goals to, and then work your way backwards to get there. I love the 401k analogy because there's just so many people that I'm talking to, like, I'm ready to build something for myself, not for somebody else. I don't want to rely off of a 401k. So I kind of want to start there. And at some point, I know you've got a website that's got all this stuff mapped out. So if and when you want to share your screen, please do. But yeah, the 401k, like the mindset behind that, why go into other stuff, like the return. I want to dig into all that stuff and kind of hear your thoughts.
So maybe we should start with kind of what I call the, I think it's a good thing to lay out is why people that are on the conventional path will never get there. So, the conventional investing wisdom is that you're going to, put your money in your company's 401k, you're going to get the match, you're going to get the tax savings, you're going to build up this mountain of, stocks, bonds, and mutual funds. And then at the end, when you're ready to quit working, you're gonna be, and because it doesn't produce any cash flow, right? You're gonna have to sell little bits and pieces of this portfolio to generate the cash flow to live on. And financial planners use something called the 4% rule. And the 4% rule says you can probably sell off 4% of your assets every year to generate the income to live on in retirement, and probably you won't run out of money while you're still alive. And so if you so a lot of people ask the question, well, how much do I need to have? How big does that mountain of stocks, bonds, and mutual funds need to be? And that's really, in my mind, the wrong question. The right question is, well, what do you want your financial freedom income or your retirement income, what do you want it to be? So let's say, you want to have $100,000 a year in retirement. Well, if you take the 4% rule and you do the math backwards, that will tell you how big that mountain needs to be. So you take the 100,000, you divide by the 4% rule, and that comes out to be $2.5 million. So all the people that are on this conventional path and they want to retire, and $100,000 works well in some parts of the country. Other parts of the country, it doesn't work so well at all, right? So for the people that are on this conventional path or just getting started, they're on that 401k highway. If they want to retire with $100,000 a year, they're going to need a $2.5 million portfolio. So how many, then you go, okay, well, that's a lot of money, right? So let's say we're a little greedy. Let's pick the median U.S. income, which I think is about $63,000. And so you apply the 4% rule to that, and you're still at $1.5 million. And now what the financial planners are finding out is that the 4% rule isn't working anymore. So they've backed it down to like the 3% rule or 3.5% rule. So now if you take that median $63,000 a year and apply the 3% rule, you're back up to a $2.1 million portfolio. And guess what? How many Americans do you think ever have a net worth of $1 million, much less two? 8% of the population. So that means 92% of the people that are out there, they're on this path, are never going to get there. So that's the why you have to switch over to alternatives, because 92% of the people are going to fail at having, what I would call, okay, just kind of a middle of the road retirement income of $100,000 a year.
92% are going to fail. Holy smokes. Yeah, that makes me think of some research that I've been doing to put out some content about the average net worth at different age brackets that comes out from some of the data. I think the data that's most available is like from like 2017 or 2019. I forget the dates.
Right.
Average versus the median. And like it's way different, because the average is going to be add up all the wealth and then divided by the people, and your billionaires are going to skew the average. But the median was like 200 at the age of 65, the median income. So if you have 100 people and you take the person that's right in the middle of the 50 person, it was like $250,000 of net worth. Right. So that's not even close to 1 point whatever or 2 point whatever. So yeah, holy crap. Okay.
So it's just interesting. I mean, even, I went to public school, and even in public school, if you only got 8% right, you failed, right? So, I mean, this is just it's a failed system, and it's making a lot of money for other people, but not for the investors. And it's just, I don't know how, you said, another thing I heard somebody, like you said, well, if I can, if you have faith in the future, there's power in the present, right? And if you look at this future state of not being able to get there, bring that back. That should be motivated to change something that you're doing today, right? And get off this 401k highway to mediocrity. So I can continue if you want me to talk about, like, the 401k and that, and this isn't even the 401k. This wouldn't matter if you invested your money outside the 401k or inside the 401k, because most people are never going to get to that balance sheet.
Yeah. The 401k, I really want to hear more about your thoughts on that versus how that compares to other things. Is like at the end of the day, in my mortgage hat, right? I'm talking to somebody and they're plowing into their 401k. They got the company match, which is great. You don't touch it for 30 something years, and they may just be getting by, and they're just going to retire off their 401k, and that's what their plan is. And maybe they scrape away some money. Maybe they buy a house, do a down payment, or they do a 401k loan, TSP loan on the 401k for down payment to buy the house. Like,
right. Which
add that up over time, like what happens? Where do they end up, landing with retirement? So,
right.
Let's dig into the 401k stuff. What is your opinion on that stuff?
Yeah, so I think they suck. Just put it right out there. So there's two big selling points to the 401k: the company match and the tax benefits. Otherwise, you would just open a Schwab brokerage account and you wouldn't mess with that. So those are the two big selling points, and there's just a ton of disadvantages, but let's talk about the two selling points. So and this is one of those things where this is how I ended up with some of my articles. One day I thought, you know what, I'll bet a single family rental is a better performing vehicle than a 401k. I'm like, I just kind of know this. I thought, well, I've never really done the math. Let me see if I can put together a scenario and do the math. And so I did. So I said, okay, well, if you put, and this would be like a one-time investment. If you made a one-time $30,000 investment in your 401k and got the average match, and if you were in the high tax bracket and you got that tax savings, that the value of the company match and the tax savings would be worth a certain amount of dollars. Now, and then if you, and so instead of making that one-time $30,000 investment in your 401k and getting the match and the tax benefits, what if you took $30,000 and used it as a down payment on a $100,000 rental property? What people don't realize is that the single family rental also has tax benefits. And what is the company match? It's nothing more than somebody else's money or other people's money. It's OPM. So the single family rental call comes with other people's money too. And the other people's money is you put $30,000 down and you got a $70,000 loan. And over the next 30 years, somebody else, your tenant, gave you $70,000 to pay off that loan. And at the end of that time, you own that free and clear. And real estate comes with something called depreciation, which you get every year for 27 and a half years on a residential property. So if you added up the value of those two, the value of the other people's money and the tax benefits for the single family rental is worth almost 3 times as much as is in the 401k. And so on the two big selling points, the 401k doesn't even stand up on that.
Okay. So that makes sense in my brain, right? Because I've done research just like you have. So
and I could, if you want to share, I can pull over just the part of this article that lays
absolutely.
those numbers out.
So let's do it. And then so for people that are going to be just on audio, we'll try to do our best to explain it. And then those that are going to be on YouTube will help you guide you through it. But yeah, this is the stuff that I think is really, really interesting because as you bring it up, one of the things that I always talk about is that, if you take 10% or sorry, $10,000 and put it in the stock market and get 1 year of return versus $10,000, buy a $300,000 house as a primary residence and just put 3% down and look at the appreciation of the house versus the stock market gain, and you put those numbers on papers, it definitely, catches your attention. So I definitely want to see the article.
Well, and let me before we go there, let's see, the last article that I wrote was titled, "Can you make money with a single family rental that doesn't cash flow and doesn't appreciate?" So I use a similar kind of example. So in this example, somebody purchases a $250,000 single family rental. They put $50,000 down. That's 20%, and the property only pays its expenses. It never, just breaks even. So they never get any cash flow, and it never goes up in value. And so, at the end of that 30 years, how did this investment do? Well,
are you able to share your screen real quick? Because I have it pulled up too.
Yeah. Okay. Let's see. Let me see here. Share screen. Share this one. Share. Okay.
And so just for the audio listeners out there, the website is prolificinvestor.com.
Theprolificinvestor.net.
Theprolificinvestor.net. And again, we're going to have it in the show notes and all that stuff. But
yeah, so this is Article 49. Can you make money with a single family rental that doesn't cash flow or appreciate? And so here's the so here's the ground rules. I know it's a little small. So you got a single family rental purchase, $250,000, $50,000 down, 20%. So your mortgage is $200,000, and you've got a 30-year fixed rate mortgage. And you'll like this. Interest rate is irrelevant. It doesn't make any difference, right? Mm-hmm. And so they own it for 30 years, and it only breaks even, and it never goes up in value. So basically, you invested $50,000. At the end of the 30 years, you've gained $200,000, and that $200,000 that you gained was somebody else paying off the mortgage. And if you do an ROI on that investment yielded an average annualized return of 13.33%. Didn't appreciate and didn't throw off any positive cash. The average annual return of the S&P 500 over its history is just a little bit under 10%. So, what if you just what if somebody just said, every couple of years, I'm just going to buy one more single family rental.
Yeah, and so from a tax perspective, the tax situation is going to be a little bit different too, right? I mean, I guess in theory, if you're selling, if I'm pulling money out of a 401k come retirement time, that is marginalized tax bracket. That's your regular tax bracket at that point, versus if you pay this thing off, you're only paying taxes when you sell it.
Right. Well, yeah, and you're gonna be showing, since it didn't generate any cash and you're getting depreciation, you're going to show a loss on this, you know, almost every year that you own it, and then when you sell it, this will be a long-term capital gains kind of thing, right?
Yeah.
And which currently is 15%. Yeah, and I didn't even put any tax consideration into this 13.33, but yeah, you have a tax advantaged asset here.
And then let's say that you keep it after you pay it off in 20 years or 30 years or whatever,
Mm-hmm.
then you're going to have just massive cash flow.
Yeah.
Just like an annuity, right?
Right. Yeah.
Versus the stock market 401k, that's just, it is what it is. And, you pull money out, you're going to get taxed on it.
Yeah.
So, okay. So this is without any appreciation, which we know, looking at a chart for 100 years, values have all gone up.
Yeah, over a
the
30-year period. Yeah, this just isn't this. It's an unrealistic example, but it shows you the power, right? Of you know of this.
Yeah, because from I guess the average S&P 500 return over 100 and something years, what do you know that number or ballpark? I think
it's 9 point something percent. It's just,
okay.
I think it's 9.8 or something like that.
Cool. Yeah, that sounds about right. So, and then what about if we do include 3% of appreciation to keep up with inflation?
Yeah, well, it's going to be better than the 13.33%, right?
Right.
So,
and that's the one thing, like, we talk about the stair step method a lot. Not everybody's got $50,000 to put down on a single family house, but somebody maybe in the middle of their journey would have that cash flow built up, and it's a great opportunity. Right. But for the person that purchases their first primary residence and has this goal of, hey, you know what, I want to build my future, I want to build my dream, not somebody else's dream. I'm going to do my job. I'm going to work as hard as I can to be able to create the extra cash so that I can build something for myself and maybe even be able to retire sooner than later, which I'm sure you're going to get into this later. But then buy as a primary residence, save up, buy the next one at a slight upgrade, also a low down payment, turn the old one into rental, and do that a couple times over 10 years,
right?
Getting in each time with a low down payment. That's also something that we talk about. So I don't want to go too much further. Anything else you want to talk about on this example before you go to the next thing?
No, this is I think that covers it. It just shows you the power of a single family rental, and particularly, people just, it's and most what's going on here is the leverage. You're using somebody else's money and somebody else is paying that off, and that's got a ton of value. That's where the whole 13.33% is coming from. It's from those monthly mortgage payments that are being paid by the tenant through the rent.
Yep. And speaking of leverage and also appreciation, so I'm going to just take 1 second to kind of give a very simple example that I use a lot talking to some clients to show the power of real estate as well. That same $10,000 amount, you get 10% in the stock market in 1 year on 10,000. What does that return? It's $1,000.
Mm-hmm.
And then you buy a $300,000 house, put 3% down as a primary residence. So that's your $10,000 roughly. And then let's say you get 3% appreciation in that first year just to keep up with inflation. What's that return going to be? Well, it's not 3,000 or whatever. I get a lot of wrong answers on this, but it's $9,000 in that first year is just 3% times the full asset. And that's one of the things I love about real estate is that you could, like you said, leverage.
Mm-hmm.
You're purchasing the entire asset. You have control of the entire asset. It's only putting dollars down of a fraction. It's just crazy.
Yeah, and that's we've got and we don't have to name them, but we've got these gurus in the United States. They're very popular. That have got a whole segment of the population thinking debt is bad. Now if you're if you're drowning in consumer debt, yes, that's a bad thing, and you need to get out of that. But eventually, you got to get out of kindergarten and get into the big C, right? The bigger desk, right? You say, okay, there's a difference between good debt and bad debt, and the truth is, really, going back to the conventional wisdom only working for 8%. If you have got a really high income, let's say you make $500,000 a year and your living expenses are only $100,000 a year. Well, that means you've got $400,000 a year that you can invest. Those people will get there with the 401k and the stock market and all that stuff. But, most people, if you got $100,000 of expenses and you're only making $110,000 a year, you've only got $10,000 of your own money. But you don't have to use just your own money. If you get into alternative investments where banks like those assets and will loan you money against them, then you've got your money plus the bank's money.
Love it. I love it. So in terms of other alternative investments, I kind of want to just dig into that in terms of what that actually means.
Yeah. So, a convention, so the investing landscape, you can really cut it in half and say, okay, conventional investments are everything that's publicly traded. So anything you can buy on the stock market, stocks, bonds, mutual funds, ETFs, those are conventional investments. Everything else is an alternative. So every type of real estate, business equipment, anything from an ATM machine to a bulldozer to a dump truck, performing and non-performing notes, commodities, cash value life insurance is a great alternative investment. Energy, oil, gas, thing with, private lending. Yeah, so it's really easy. There's the stock market, and then there's everything else.
So in all those examples that you mentioned, what would be an example that would be simple and easy to kind of talk about or give an example on?
Well, let's maybe we could talk about, I would say, a single family rental. And if you want, we can talk about the three different ways to get started. The three different ways from the very direct do-it-yourself way to the syndication path.
Yeah, let's do that.
Okay, so I'm going to switch over to a different article. Let's see here. It's article 46, 3 ways to get started in real estate. So, so here I've got a kind of a table, and there's lots of ways to invest in real estate, but these are kind of 3 pretty common ways. So one is the single family rental, what I call the do-it-yourself. That's where you go out and you get a realtor, you find a rental, you buy it, you get the loan, you screen the tenants, and it's within 30 miles of where you live, and so you manage the property. You're doing everything. You're the handyman, you're the property manager, you're doing everything. And so and then another way is something called a single family rental turnkey. So in the country, there are what are called turnkey single family rental providers. And these are people that might specialize in single family rentals in a particular market. Let's say Tennessee. And so they go in that whatever market they're in Tennessee, and they buy up, or sometimes it's new construction, but mostly they will buy up single family rentals that fit, the 3-bedroom, 2-bath, whatever is a good rental for the working class in that market. And they'll do durable repairs and get them ready, and then they will put them up for rent, and they will get qualified tenants, and they will manage them, and that's their forte, managing a whole bunch of single family rentals in this Tennessee market. And then you come along and buy it from them, either with cash or with the bank loan. And that's what's called buying a loaded rental. And so you didn't have to, all you had to do was show up with the bank loan or cash. And now you've got, a single family rental that you own with property management and tenants in place. And you're going to be, basically managing the property manager. And then the third way.
So wait, hold on. So
sure.
Managing the actual property manager. So that means someone else is going to be doing all the legwork, the the repairs, the calls, the filling
Right.
the voids in the units,
Right.
and then as the regular person out there, just making sure that they're doing their job properly.
Yeah, they're doing their job, and there'll probably be some rules set up like okay, any repairs that are under $500, I don't need to know about them. Just handle them, and then you need a new roof or a new furnace or whatever, and then the property manager is going to say, hey, we've got this coming down the road. How do you want to handle this? Have you got somebody? Do you want me to find them? So there'll be some things that the property management company will do automatically, and there'll be things that they'll need to check with you about.
The actual cost of a property manager, 8%, 10%, 12%. Is that kind of what you're thinking too?
Yeah, I want to say I was going to say 8 to 10%, depending
Okay.
on the market.
Okay. Whereas like if it's a short-term rental property,
Oh yeah,
that percentage is going to be quite a bit higher. So just to kind of distinguish for the audience out there.
Exactly. Yes. And then the other way is through a syndication. And a syndication is nothing. Well, let me back up. A syndication is nothing more than a bunch of people pooling their money to buy an asset that they couldn't buy on their own. So when you're driving down the road and you see a 200 unit apartment building, it's very unlikely that one person came in and bought that with cash or even put up the down payment. What's more likely is they set up a company and they had a couple of general partners who were running this thing, and they came to 100 limited partners like me and said, hey, would you like to participate in this investment? You bring some money to the table, we'll manage the deal and put some money in, and then we'll split the profit 70-30, 60-40, whatever the operating agreement. So that's a syndication. And when you do that, you just kind of wire off your money and that's it. And then what I've done on this table here, getting back to, is I've compared these three types of investment in terms of how much knowledge and skill is required for each one, what's the risk, what's the time commitment, tax benefits, are there economies of scale, what's the minimum investment, and what's the return on investment. And so the most interesting thing I think is if you start with the do-it-yourself single family rental, and I used an actual single family rental that was available from a turnkey provider in Tennessee. And if you managed it yourself, you're going to get about a 15% return on your $50,000 investment, which would have been your down payment. And then if you had the single family rental provider manage it, your return's going to drop from 15% down to 11 because you're paying them a portion of the proceeds to do the management. But as you go across here, you can see there's actually less and less time involved on your part. If you're doing it yourself, you're doing it everything. If you have a turnkey provider, you've hired them to do something, so your returns are initially going down. 15% doing it yourself, 11% with the turnkey provider. But when you go into a syndication, this is where you have the least amount of involvement, and you can get into syndications for as little as $50,000. And I put here a 20% annual return. I'm personally experiencing almost always 25% and higher annual returns on my syndication. So the counterintuitive part is, wow, you mean the place where I actually have to do the least amount of work, I get the most return, and with almost very little involvement on your part. Your job is to pick a good syndicator.
Right. So the syndication process, right? So you kind of have two different sides of the puzzle. The person that is putting up the money, the passive investor, and you have the people that, hey, you know what? I don't have the money, but I found a really good deal on a certain size of a property. Because you're not going to do a syndication on a small property, right? It's got to be a certain price.
Well, you could do. I mean, you could do it on anything. I mean, if you're let's say you're a young guy. You've got a bunch of real estate knowledge, and there's a 12-unit apartment building. That could be a syndication. So, and one thing that I like, and everybody's got to start somewhere. So there might be somebody who's starting out, and he's bringing the knowledge and skill to the table, and you're bringing the money. I like to be with somebody who's done this for a while and who's putting their own money in alongside of mine, as well as running the deal. because there's no reason why you if you're and basically these are the general partners, the people that are running the thing, and the limited partners. If you're a general partner and you're not putting money into your own deal, I would question why, right?
Yeah. So you kind of have the questions that are going through my brain that I know that people out there may be asking is, the logistics of setting it up, the paperwork, attorneys, all that stuff that has to get done, mapping out the return expectations and the distribution of profits over time. And then
right.
From a high level, though, I want to really quick dig into, well, why is the return higher? You're doing less work, but why is the return higher?
Well, I think there's a couple things. So the people and if you get with a good syndicator, these people are experts at what they do. They're experts at selecting, and I'll pick apartment buildings, at selecting and managing and driving efficiency into this apartment. That's what they're an expert at. And think of so if you go out and buy a single family rental, and you have one vacancy, you're 100% empty, right? And all your costs are spread across that one tenant. If you go out and buy a 100 unit building and you have one apartment vacant, you're only 1% vacant. And there's just like anything else, there's economies of scale here. So the bigger it is, you just have the opportunities for higher profit margins.
Okay. So, and you mentioned 25% is something that you're really expecting on the stuff that you're working on. Mm-hmm. Are you okay sharing an example of something that you've been involved with?
Yeah, absolutely. I mean, let's see if let me pull up some. I've had two apartment buildings go full circle this year, meaning that they sold this year. And let me just anecdotally, there was one down in the Atlanta, Georgia area, and it was a $40,000. I'm trying to see if I can actually pull up the actual numbers, so I'm not kind of speaking on. Yeah, it was 40,000 that turned into 75. And the typical one is $50,000 investment that 3 or 4 years later is coming back at 100. So when you're getting 25% average annual returns, you can go, oh man, I call it sending my money out and having it come back with twice as many friends 4 years later. So think about doubling your money every 4 years, and that's routinely happening with stuff that I'm in.
Okay, so let's take the one where you said the first one you said was $40,000.
Yeah.
So you put $40,000 in as a limited partner,
right?
And so on that example, what was the actual project like? Was it an apartment complex? Like what type of price range was the deal? Oh, here comes the numbers.
Oh, it was a let's see. I'm trying.
You can just ballpark. It doesn't need to be exact. Just general.
Oh, these are this would be hundreds of units, and I can get to it.
Because the syndicator, right? Like you mentioned that the right type of person is somebody that's done it before, right? And so at some point I kind of wanted to, well, how did you find, is it a friend of a friend? Were you introduced to the person? How did you get connected to that?
So
yeah. That they were good.
No, so this is a great question. That's people say, well, how do I get started? How do I find these syndicators? Well, you're not gonna get them from your Uncle Joe the plumber. You're not gonna find them at Friday night watching the football game. So you're this is a whole different world, and you're going to have to start immersing yourselves in. There's books you need to read, there's podcasts you need to listen to, and the best way is to join some kind of investment group or club where this is what people do. And so rather than just getting on the internet and looking up apartment syndicators, you belong to a group where you can say, hey, what are the apartment syndicators that you guys know of? And I go to a bulletin board and say, okay, well, who's done business with these guys and what was your experience? So you want to get this on a referral basis.
Okay. Now
The place that I belong to, and I have no gain that I have no monetary stake in this. Just helping the audience here is a group called Left Field Investors. So if they go to leftfieldinvestors.com, there's lots of free stuff there. They also have an infielders group, which I think costs $200 a year. And with that, you get access to all of these forums and things where you can go in there and look at reviews and post questions. And that's some of the stuff that I do. And they had a meeting up in Columbus, Ohio this year. And so I went up there, and you get to, the nice thing is, when you invest in Coca-Cola, you're never going to go and have lunch with the CEO of Coca-Cola. When you invest in with these syndicators, you can meet them, and talk with them and get your own judge of character and know personally who you're working with. Right.
Cool. So you mentioned an unbelievable source, and the last time we spoke, I checked out the website, and it's loaded with amazing information and good people. Yep. There's local meetups, there's local investment groups on Facebook. You can Google it. There's, if anybody needs any help on that part, we can definitely point you in the right direction.
Yeah, there's a resources page on my website where I have, syndicators that I've used, and books and podcasts, and Left Field Investors is listed there as well. So yeah, it's like anything else. It's just kind of an industry. This passive investing, and you've kind of got to start knocking on those doors and making yourself part of these groups and start associating with some different people.
So what I'm going to do, and this is just how my brain works, and maybe somebody gets bored, maybe somebody appreciates it. I don't know. So let's say I've got $40,000. I've got the calculator up, and let's say that we're talking over 4 years, we're going to get a 25% return. So what I'm going to do is I'm going to take this, times it by not 0.025. I'm going to do 1.25, so it spits out the full number. Mm-hmm. So a 25% return on 40,000 is $10,000 gain. Right. So 40,000 times 1.25 gets to 50,000. So that's your full number. And then if I do that a couple more times 1.25, 62, and then times it again, that's 78. And then one more time, I'm at 97,000.
Yeah.
So more than double potentially.
Yeah. Right. Yeah. The particular syndicator that I do most of my investments with, I think they've even got it on their website. They have a list of all the apartment buildings that they've sold, and when they add up, when they do the average annual return of all those sales, it's over 30%.
Wow.
So I've hit some 25% numbers, and I think there's one more that's gonna close this month is gonna be at 30%. So, when you have an average of 30, you've got some that are way above, you got some are below. Right. Their performer is almost typically around 20. So that's what they model on, and they're just almost always performing that by a pretty good margin.
Yeah, that's awesome. And that's one thing too that I think is very interesting too, is you put money into the 401k. The stock market's going to go up and down. You're just going to be probably put into a basket of funds or whatever, and certain things are going to go up and down, whatever. But in real estate, in the past 100 years, in terms of actual home values, other than 08, 09, where the actual recession was caused by the housing issues with the mortgage-backed securities and blah, 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 blah. Yep. Home values pretty much stay stable or keep going up. And so you put money into the market, and maybe the stock market's going down, but people still need to pay rent.
Right.
Maybe it goes down a little bit, but people are still having a place to live. So I don't want to say recession proof, but would you say that there's some type of minimization of the ups and downs?
Yeah, well, the alternatives in general and real estate have much less volatility than the stock market. I heard some guy say something really great at a conference. He said, the value of your property only matters 2 times: the day you buy it and the day you sell it. If you bought it for cash flow, it doesn't make any difference what the value is in between those points. And I bought a condo in the Seattle area at the height of the market, right before the crash of 08, and that condo lost half of its value in that downturn. But guess what? The rent continued to climb over the the years that I owned it after that. And I don't remember how many years, 5-6 years later, I sold it for a profit. So I didn't care that so it went down by 50%. It was still generating positive cash flow, and the value came back, and I sold it. And so, yeah, who cares? And that's a great. I don't know how conventional investors sleep at night. With the ability to constantly watch the fluctuation of their stocks, which are based on emotions, and most of the time have nothing to do with the fundamental business. That the stock is around. Right.
That's so true. That's so true. From a tax perspective, so you put the money in, and it goes to the syndicators. They take it. They do their thing with the properties, they manage it, get their returns. And then when it sells, right? A lot of investors, when they have big properties, they'll do, I guess, a 1031 exchange, sell something, tax shield it, buy the next one. Yeah. As a passive investor, what are the tax implications? How is it taxed?
Yeah. Well,
maybe you do, maybe you don't. I don't know.
Yeah, you receive it's a partnership. The company that you're involved in is a partnership. So you receive your income on a K-1. And what happens is, especially after the tax laws that President Trump passed, now this is changing. This is kind of phasing out, whether it'll come back. But so there was something called bonus depreciation. So I had an actual syndication that I invested in where I wired off $100,000. And there was so much depreciation with that property, and you could accelerate it all to the first year. So my K-1 for that year was negative $105,000. Now I didn't lose $105,000, but I got a $105,000 loss that I could use to offset income. Let's say I had a bunch of apartments that I had bought before that, and they were all generating cash every year. Well, the first $105,000 of that would have been tax-free, because I would chewing up that 105. And if I didn't have $105,000 or any passive income, then that would just carry forward to the next year and the next year and the next year. So typically what happened, we call it the golden hamster wheel. You buy these you make an investment in these apartment buildings, you get a chunk of losses you can't use initially, and then you build those up. And as you have properties mature and you sell, then you just bleed down those losses. So most of the income, if you do it right, is tax-free. You don't have to do a 1031 exchange, and it's really hard to do a 1031 exchange with a syndication.
Okay. Gotcha. That makes sense. Well, we're running down on time. There's a lot more to dig into. So this is going to be part 1, and we're going to have Chris back on and do part 2 as we dig into some more of these ideas, examples, and alternative investments and how it all fits together. Because at the end of the day, talking about someone's journey, and I was just posting about this literally yesterday on Instagram, that the only difference between somebody that has one property that just started their journey and somebody that has a $10 million portfolio or a $7 million portfolio, the biggest difference is time. Now, strategy, knowledge, skills, income, all that stuff matters. But the biggest thing that I feel like people forget is that you just don't have enough time for your actions to compound your properties, to build them value and appreciate and compound. So just a reminder for people out there, this stuff, it's not an overnight thing.
Along those lines, that's one of the advantages of syndication. So think about building a diversified portfolio of single family rentals, one house at a time, with $50,000 of investments. So the one syndicator that I use has minimums as low as $25,000. So every time every $25,000, I could be in an apartment building in a different city, in a different state. And so you're instantly getting economies of scale, and both geographic and building, diversification with every little investment that you do, whether it's $25, $50, or $100,000. It's harder to do that, one single family, and managing these places all over the country, so.
Totally. Yeah. I mean, real estate has changed my life. Like, I bought my first properties, and I bought a couple of multifamilies in 2017, like Rich Dad Poor Dad, like you mentioned, that book, was very helpful to really kind of change my mindset. But like the time part, I just didn't get it. I wasn't thinking 10 years down the road, 5 years down the road, that, hey, when values go up and that mortgage gets paid down, I can maybe even tap into some equity there to be able to purchase the next property.
Yes, right.
And that money you pull out is tax-free. So we got a lot to dig into on round 2. I'm looking forward to it. But Chris, Odegard, and then the book again.
The book is Get Off Your Ass and Manage Your Money, Why You Need Alternative Investments. If you go to the prolificinvestor.net, you'll find everything there. There's a link to the book. It's right there on the front. So
what is if I'm thinking about purchasing that book, what is the biggest thing that I'm going to be able to get in terms of a roadmap or information? What's the biggest thing I'm going to be able to take from it?
Well, if you're not already convinced, hopefully you're going to walk away and go, oh my gosh, why am I in conventional investments? Why am I putting my money in the stock market? Chris has convinced me by comparing conventional alternatives over 13 different categories. And there is a downloadable guide that you can get that's kind of my attempt to give you the straightest and most efficient path. And it's mostly an education path because you've got to decide of all the different asset classes in the alternative side, which way you want to go and which one fits best. And do you want to be putting a lot of your time in it, or do you want to be hands off like me? So there's no equivalent of the Vanguard, retirement fund targeted out in 2042, right? So it takes a little bit more work, but it's well worth it.
Awesome. Well, thanks for making time out in your busy schedule for us today. Thanks so much, Chris, and looking forward to round 2.
Okay. Thanks, Joel. Take care.
All righty. Bye.